I've been around markets long enough to learn that most of the trouble a trader gets into doesn't come from ignorance. It comes from thinking he knows something that the market has not yet proven. That's a hard thing to admit, because every man likes to believe his opinion has weight, but the market doesn't care about opinions. It only answers to facts written in price. And price has a way of forcing you to confront whether confirmation actually exists, or whether you've been assuming it all along. When I first began watching charts and tape, I thought confirmation was something I could reason my way into. I'd see a pattern, connect a few ideas, and say to myself, that's enough. The market agrees with me. But does it? Or did I just want it to? That question, asked honestly, can save you years of tuition in losses, because the market never confirms with words. It confirms with action, and action takes time. Most traders don't wait for that time. They get a notion in their head, and then they go looking for evidence to support it. They read the news that fits. They notice the one bar that agrees with them, and ignore the 5 that don't. You've done it, haven't you? I certainly have. You call it confirmation, but it's really hope dressed up in logic. And hope is a poor companion when real money is at risk. True confirmation is not something you argue into existence. It arrives whether you're ready or not. It shows up when price behaves in a way that leaves little room for doubt. Higher highs that hold. Lower lows that follow through. Volume that steps in when it should, not when you wish it would. If you have to explain too much, if you have to convince yourself, then confirmation is probably missing. And the market is quietly waiting to teach you that lesson again. I learned early that being early feels the same as being wrong. The account doesn't reward anticipation. It rewards correctness. Yet traders are always trying to be first. First into a breakout. First to call a top. First to spot a reversal. But what's the hurry? Do you get paid extra for guessing before the market speaks? Or do you get paid for being on the right side once it has spoken clearly? When a stock is truly ready to move, it doesn't whisper. It tells you in plain language. It acts right. It doesn't hesitate at obvious levels. It doesn't need your encouragement. And when you see that kind of behavior, you don't need to ask 10 questions. You don't need to assume anything. The confirmation is there in black and white, printed on the chart. The trouble is, confirmation often comes after the easy fantasy profits are gone. That's why so many traders skip it. They see the move starting and think, if I wait, I'll miss it. But miss what? A guess. A gamble. There will always be another trade. There will not always be another account. Preservation comes first, and confirmation is part of preservation. It keeps you from acting on every bright idea that crosses your mind. I've always said that the big money is made by sitting, not trading. Sitting requires certainty, or at least as much certainty as this business allows. And certainty only comes from confirmation. Not the kind you invent, but the kind the market gives freely once it's ready. Until then, all you really have is an opinion, and opinions are expensive. Ask yourself this the next time you feel eager to enter, has the market actually confirmed my idea, or am I just tired of waiting? That's an uncomfortable question, but an honest one. Impatience has a way of pretending to be confidence. You feel bold, decisive, but look closer, and you'll often find you're just bored or afraid of missing out. Charts don't reward excitement. They reward discipline. A trader with the right mindset understands that cash is a position. Waiting is a position. And sometimes the best trade you make is the one you don't take because confirmation never arrived. That kind of restraint doesn't show up on a profit and loss statement right away, but over time it builds something far more valuable: consistency. Wealth in trading isn't built by heroic calls. It's built by aligning yourself with what is already happening. Confirmation is alignment. It's the moment when your thinking and the market's behavior point in the same direction. Until then, you're just leaning, hoping the wind doesn't change. And the wind in markets changes without warning. I've watched traders blow up not because they were reckless, but because they were convinced. Convinced that a support level had to hold. Convinced that a breakout should work. Convinced that the market was wrong. The market is never wrong. It simply is. When you accept that, you stop trying to force confirmation and start waiting for it. There's a quiet confidence that comes from trading only when things line up. You don't feel the need to defend your position. You don't stare at every tick. You've seen this picture before, and you know how it tends to resolve. That confidence doesn't come from intelligence or inside information. It comes from experience and from respecting confirmation as something earned, not assumed. A trader's mindset must be built around humility. You are not here to predict. You are here to observe and respond. Confirmation is the market's way of saying, now. And when it hasn't said that yet, your job is to stay silent. That silence, repeated over years, is what separates the survivor from the casualty. And still, even with all this said, the temptation never fully disappears. Every setup will test you. Every slow market will whisper that maybe this time you don't need full confirmation. Maybe this time you can be a little early. That's when discipline matters most. Because the moment you start assuming confirmation instead of waiting for it, you're no longer trading the market. Assuming agreement from the market is a form of disguised impatience, and impatience is one of the most costly habits a trader can carry. It doesn't announce itself loudly. It doesn't feel reckless at first. In fact, it often feels reasonable. You tell yourself you're being decisive, that you're trusting your experience. But if you look closely, you'll see that impatience usually shows up the moment the market refuses to move on your schedule. The market has its own time. It always has. Price moves when conditions are ready, not when your analysis is complete or when your nerves can't take waiting anymore. When a trader assumes the market agrees with him before price proves it, he's really saying, I don't want to wait any longer. That's not confidence. That's discomfort. And discomfort has a way of pushing men into trades they would never take if they were calm. You can see this impatience clearly on a chart. A trader buys just before resistance because he believes the breakout is obvious. He sells short just above support because it can't go any higher. In both cases, he's assuming agreement. He's decided the market must do what seems logical to him. But logic doesn't move prices. Orders do. Until those orders appear in force, the market hasn't agreed to anything. Impatience often hides behind the phrase, pricing it in. A trader will say the move is already reflected, that waiting for confirmation means being late. But late to what? Late to certainty. Late to risk reduction. The market doesn't penalize patience. It punishes arrogance. And assuming agreement is a quiet form of arrogance, even when it feels modest. Most traders don't realize how much emotional energy goes into waiting. Sitting still feels unproductive. You're watching bars form, seeing small movements that almost look like your idea is working. Almost is a dangerous word in trading. Almost invites assumption. Almost invites impatience to step back in and say, this is close enough. And close enough is never good enough when money is on the line. I've learned that the moment you feel the urge to justify a trade before entering it, impatience is already present. You start stacking reasons. You talk about what should happen. You imagine how fast it will move once it starts. All of that mental noise exists because the market itself hasn't yet done the convincing. If it had, you wouldn't need the story. A patient trader waits for the market to remove doubt. An impatient one fills the gap with belief. Belief feels solid until price moves the other way. Then it evaporates. The market has a way of exposing assumption by doing nothing at all. It goes sideways. It stalls. It refuses to follow through. And the impatient trader, already committed, feels trapped inside a position that never should have existed. There is also a financial cost to impatience that goes beyond a single loss. Acting too early ties up capital. It drains focus. It creates emotional baggage that spills into the next decision. One assumed trade leads to another adjustment, then another rationalization. Before long, you're managing mistakes instead of managing risk. All because you couldn't wait for agreement that was never actually there. Wealth in trading grows from repetition of sound decisions. Sound decisions require clarity. Clarity requires waiting until the picture is clean. Impatience blurs that picture. It makes weak setups look strong and random movement look meaningful. You begin to see what you want instead of what is. That habit doesn't just affect one trade. It shapes your entire approach to the market. I've noticed that traders who assume agreement often trade more frequently than they should. They're always involved, always exposed. They confuse activity with progress. But progress in trading comes from alignment, not motion. The market doesn't reward how busy you are. It rewards how accurate you are. Accuracy takes time. And time is exactly what impatience refuses to give. There's a mental shift that must happen if you want to last in this business. You stop asking when the move will happen and start asking whether it has already begun. That difference is subtle but critical. One question invites assumption. The other demands evidence. Evidence is the enemy of impatience because it can't be rushed. The longer you trade, the more you realize that missing trades is not the real danger. The real danger is participating in trades that were never ready. Those trades teach you the wrong lessons. They make you doubt sound methods and trust flawed instincts. And over time, that erosion of discipline costs far more than any single missed opportunity ever could. When a trader finally accepts that waiting is part of the job, impatience loses some of its power. You begin to see that the market isn't withholding anything from you. It's simply operating on conditions that don't care about your timeline. And once you stop assuming agreement, you start noticing how rarely the market actually gives it, how specific and deliberate those moments are, and how different they feel compared to the rushed decisions that once felt urgent, but were really just impatience, asking to be mistaken for confidence. Being early feels identical to being wrong in real money terms, and that is one of the hardest truths a trader ever has to accept. The market doesn't give partial credit for intention. It doesn't care that your idea eventually worked weeks later. Your account only records what happened while you were holding risk. And when you enter too early, the market treats you no differently than someone who made a bad call altogether. A trader who is early often tells himself he's being perceptive. He believes he's seeing something before the crowd. That belief can be intoxicating. It makes him feel sharp, ahead of the game. But the market doesn't reward foresight unless it is timed correctly. Until price confirms the move, foresight is just speculation. And speculation, when paid for with real money, produces the same stress, drawdown, and doubt as being outright wrong. I learned long ago that the market has no sympathy for correct ideas with incorrect timing. You can be right in theory and still lose money in practice. That's because timing is not a detail in trading. It is the trade. Enter too soon, and you're exposed to every shakeout, every hesitation, every test that happens before the real move begins. Those tests are designed to wear out weak positions, not reward them. When you're early, the market feels hostile. Price doesn't move the way it should. It stalls, backs up, dips just enough to make you question yourself. You start watching every tick, reading meaning into noise. Emotion creeps in, because your capital is at risk before the market has committed. That emotional pressure is identical to what you feel when you're wrong, because in that moment, functionally, you are. The chart doesn't know you're early. It only knows where price is relative to structure. If support hasn't held yet, you're guessing. If resistance hasn't been cleared, you're guessing. Guessing is not a strategy, no matter how confident it feels. And confidence without confirmation is fragile. It cracks the moment price moves against you. Many traders confuse being early with being disciplined. They say they're building positions, that they're scaling in before the move. Sometimes that can be true, but more often it's an excuse to justify discomfort. If the trade truly had confirmation, there would be no need to endure the discomfort. You'd be entering strength, not hoping weakness would stop. The financial damage of being early isn't always immediate. Sometimes the market eventually does what you expected, but by then, you've paid a psychological price. You may have reduced size, tightened stops, or exited too soon because the early entry drained your patience. So even when the idea works, the execution fails. That's another way being early equals being wrong. Being early also distorts your perception of risk. When price hasn't yet confirmed direction, Every fluctuation feels dangerous. Your stop placement becomes arbitrary. You move it, justify it, widen it. Risk management weakens because you're operating without structure. The market hasn't drawn the lines yet, so you draw them yourself, and they rarely hold. I've seen traders hold early positions for weeks, tying up capital and attention, only to exit right before the real move begins. They tell themselves the market tricked them. But the truth is simpler. They entered before the market was ready, and the waiting cost them clarity. When the opportunity finally arrived, they were no longer in the right mental state to take advantage of it. The market rewards alignment, not anticipation. Alignment means your position agrees with current price behavior, not future hopes. When you wait for confirmation, you enter alongside momentum, not in front of it. That reduces friction. It gives your trade room to breathe, and it allows you to judge the trade based on evidence instead of emotion. There's also a discipline lesson hidden here. A trader who accepts that being early feels the same as being wrong learns to value patience differently. He stops trying to predict the exact turning point. He lets the market prove itself first. That shift doesn't make him slower. It makes him more accurate. And accuracy is what compounds over time. Wealth in trading isn't built on catching the first dollar of a move. It's built on catching the reliable part. The part where the market has already shown its hand. Being early may flatter the ego, but it starves the account. Consistency comes from repeatable conditions, and repeatable conditions only exist after confirmation. I've always believed that the market offers plenty of opportunity to those who can wait. The problem is that waiting feels like doing nothing, and doing nothing feels wrong to the human mind. So traders act early to feel involved. But involvement is not the goal. Profitability is. And profitability doesn't care how soon you got in, only whether you got in at the right time. When you look back over your losing trades, many of them won't be bad ideas. They'll be early ideas. Trades that needed more time, more proof, more development. And when you see that pattern clearly, you begin to understand that the market wasn't against you. You were simply asking it to move before it was ready. The longer you trade, the more respect you gain for confirmation. You see that waiting for it doesn't eliminate opportunity. It refines it. You trade less but better. You take fewer hits, and the hits you do take are cleaner, easier to accept, easier to manage. Being early keeps you busy. Being right keeps you solvent. And the moment you truly accept that the market does not distinguish between early and wrong, you begin to approach each setup with a different question, watching not for what might happen, but for what is already starting to happen, and whether price has finally reached the point where it no longer needs your patience, but demands your participation. True confirmation reduces the need for constant monitoring, and that's something most traders don't understand until they've exhausted themselves doing the opposite. They think good trading means watching every tick, every bar, every flicker on the screen. They sit there tense, afraid to look away, convinced that if they stop watching, the market will do something unforgivable. That behavior doesn't come from opportunity. It comes from uncertainty. When a trade is truly confirmed, it carries its own sense of order. Price behaves the way it should. Structure supports your position. Risk is defined, not imagined. In that state, there's very little to watch. You already know what must happen for the trade to remain valid, and what must happen for it to be wrong. Everything else in between is just noise. Constant monitoring is a symptom. It's not diligence. It's doubt. When a trader keeps checking the chart every minute, adjusting his bias with every small move, it usually means the market never fully agreed with him in the first place. He entered with questions still unanswered. And now he's hoping attention will substitute for confirmation. I've noticed that the most exhausting trades are the ones taken without full confirmation. You enter, and immediately you're on edge. Price hasn't proven itself yet, so every pullback feels threatening. You zoom in, zoom out, switch time frames, look for reassurance. That kind of trading drains energy fast. Not because trading is hard, but because uncertainty is heavy. A confirmed trade doesn't require babysitting. It doesn't need constant defense. If the market has shown its hand clearly, then short-term fluctuations don't matter much. You're aligned with the dominant direction. You're not relying on luck. You're relying on behavior that's already visible. That allows you to step back mentally and physically. Many traders believe that watching more closely will improve results. But watching doesn't change price. It only changes your emotions. And emotions, when stirred too often, lead to poor decisions. Over-monitoring causes premature exits, unnecessary adjustments, and second-guessing. All of that comes from the same source: lack of confirmation. When confirmation is real, you don't feel the need to interfere. You don't argue with the chart. You don't interpret every candle as a message. You already know what you're looking for. Either the market continues to act right, or it doesn't. That simplicity is powerful. It frees your mind to think clearly instead of react constantly. There's also a wealth principle tied into this that many overlook. Mental capital is just as important as financial capital. If every trade requires your full emotional attention, you burn out. You start forcing trades just to feel engaged. But when confirmation is solid, trading becomes more efficient. You can manage risk without obsession. You conserve energy for the moments that matter. I've always believed that a trader should feel slightly bored when properly positioned. Not careless, not indifferent, but calm. Boredom in trading often means the work has already been done. The analysis was sound. The entry was correct. The confirmation was clear. There's nothing left to do but wait for the market to complete what it has already begun. Contrast that with a trade built on assumption. You can't stop watching it. You feel responsible for guiding it somehow, as if your attention might influence the outcome. That's an illusion. The market moves on orders, not on observation. The more you watch, the more tempted you are to act without reason. True confirmation also sharpens your exits. When the trade is well confirmed, you know exactly what invalidation looks like. You don't hesitate when it appears. You don't negotiate with price. You act cleanly. That decisiveness is impossible when you've been monitoring every wiggle, because you've trained yourself to react instead of decide. Many traders think constant monitoring is a sign of professionalism. In reality, it's often a sign of insecurity. Professionals trust their process. They trust confirmation. They understand that once the market has spoken clearly, it doesn't need to be interrogated every minute. They let price do the work. There's also a practical side to this. Monitoring limits your ability to scale. If you must watch every position constantly, you can't manage multiple opportunities effectively. You become reactive instead of strategic. Confirmation allows distance. Distance allows perspective. And perspective is what keeps traders from making emotional mistakes. The market doesn't reward attention. It rewards alignment. Once alignment is established, less interference produces better results. That's not laziness. That's respect for the structure of price movement. You're acknowledging that the trade is no longer about you. It's about the market following through on what it has already demonstrated. When confirmation is absent, monitoring becomes a substitute for control. You try to manage uncertainty by watching it, but uncertainty doesn't shrink under observation. It only becomes more noticeable. And the longer you sit inside that state, the more likely you are to do something unnecessary. Over time, traders who survive learn to value quiet trades, trades that don't demand attention, trades that behave properly without supervision. Those trades are usually the result of waiting longer before entry, not watching more after it. Confirmation shifts effort from management to selection, which is where real skill lies. True confirmation simplifies trading. It reduces noise, stress, and emotional involvement. It turns trading into a series of clear decisions instead of a constant stream of reactions. And once you experience that contrast, it becomes difficult to justify the old habit of staring at the screen all day, mistaking anxiety for responsibility, especially when you begin to notice how little you actually need to do once the market has already confirmed what it intends to do. Charts reveal confirmation quietly, never through excitement, and that's something most traders struggle to accept because excitement feels like opportunity. Fast moves, big candles, sudden volume spikes. These things stir emotion and make a trader feel like something important is happening. But emotion is not confirmation. Noise can be loud without being meaningful, and the market often hides its most reliable signals in calm, unremarkable behavior. Real confirmation doesn't announce itself with fireworks. It shows up in steady progress. Price holds levels it should hold. Pullbacks stay controlled. Breaks don't immediately fail. There's a sense of order in the movement. Nothing dramatic, nothing urgent. And because it's quiet, many traders miss it or dismiss it as boring. Excitement usually appears before confirmation, not after it. You see it when price approaches a key level, not when it has already accepted above or below it. That excitement is the market inviting participation before it has made a decision. Traders feel that energy and mistake it for clarity. They jump in because it feels alive. But feeling alive doesn't mean being aligned. I've noticed that the most dangerous trades often feel thrilling at the start. There's speed, momentum, chatter. Everything seems to line up all at once. But that intensity fades quickly if the market hasn't truly committed. Price hesitates, reverses, or stalls, and the excitement turns into anxiety. That emotional swing is the cost of acting before confirmation. Quiet confirmation feels different. It doesn't raise your pulse. It doesn't make you feel clever. It just makes sense. You look at the chart and there's very little to argue with. Levels are respected. Structure is intact. The move doesn't need hype. It's already underway. That kind of setup rarely attracts attention, but it attracts follow-through. Charts communicate in behavior, not emotion. A trader who learns to read that behavior stops chasing excitement. He starts observing consistency. Is the market doing the same thing repeatedly? Is it reacting the same way to similar conditions? That repetition is a form of confirmation, and it rarely comes with drama. Many traders think they need to feel something to justify a trade. If it doesn't feel urgent, they think it's not worth taking. But urgency is often a sign that the decision is being rushed. The market doesn't rush, it unfolds. And confirmation unfolds quietly, one bar at a time. You can see this clearly in trends. Strong trends don't explode every day. They grind. They pause, resume, and pause again. The confirmation is in their persistence, not their speed. A trader waiting for excitement will miss most of the move. A trader watching for consistency will stay aligned longer. Noise is seductive because it promises quick results. Quiet confirmation promises durability, and durability is what builds accounts. The market rewards those who can sit with calm movement and trust it, rather than those who chase every burst of action hoping it means something. I've found that when a chart makes me emotional, it's usually not confirmed. The trade feels personal. I want it to work. That's a warning sign. When a chart feels almost dull, when the outcome seems obvious but not thrilling, that's often when confirmation is strongest. There's also a mindset shift required here. Traders are conditioned to believe that opportunity should feel exciting. That belief comes from outside the market, from stories, headlines, and exaggerated wins. The market itself is more understated. It doesn't celebrate its intentions. It simply carries them out. Quiet confirmation also protects you from overtrading. When you stop reacting to excitement, you trade less. You wait more. You let the chart speak fully before you act. That restraint filters out many weak setups that look good only because they're loud. The wealth-building side of this is subtle but important. Long-term success in trading comes from repeatable behavior, not emotional spikes. Quiet confirmation is repeatable. Excitement is not. You can't build a process around adrenaline. You can build one around structure and consistency. I've always trusted trades that didn't need convincing. Trades where I didn't feel the urge to talk myself into them or defend them. Those trades usually came from quiet charts. Charts that weren't attracting attention, but were doing exactly what they should be doing. When you study charts long enough, you begin to notice how often major moves begin without fanfare. They start small, they test, they hold, and by the time excitement arrives, much of the confirmation has already passed. Those who wait for noise end up late. Those who listen for quiet behavior are already positioned. The challenge is learning to be comfortable with that quiet, to trust something that doesn't stir emotion, to accept that the market's most honest signals are often the least exciting. that comfort doesn't come quickly. It comes from seeing the same quiet patterns lead to the same outcomes again and again. Charts don't lie, but they also don't shout. They speak in measured tones, and once you train yourself to listen for those tones, instead of reacting to the volume, you stop chasing movement and start following intent, watching the market reveal itself not in bursts of excitement, but in the steady, almost indifferent way it carries price forward when it has truly decided to go somewhere.